Okay. So she is married, filing jointly. She's got some dependents. She is paid bi-weekly. So again, we're going to do a number 5 here. So bi-weekly. Checkbox is checked. Let's see. She has 3 dependents, ages 7, 14, and 18. So this pertains to the W-4, step 3. So she would have 2 dependents under the age of 17, and she's got 1 who's 18, so over the age of 17. So her tax credits that she's claiming would be $4,500. So step 3 is $4,500. And let's see. Okay, so on her, so that's it for her W-4, but we've got to figure out what her taxable wages are, right? So she's, her wages are $3,000, so we'll start with the $3,000, but she also has, she contributes $150 each pay period to a 401k, a retirement plan, and $200 each pay period to health insurance. So those are both pre-tax with amounts that she is paying, so they're going to reduce her taxable wages. So minus the 150, minus the 200, so $2,650 are her taxable wages. All right, so that's our information that we've got here. Now we can go over and we can look, well, I'll put this all the way over here so you guys can see that. And we'll pull up the pub. I'm not gonna go through the wage bracket method with you. I'm just gonna go through the percentage method. I have posted an answer key in Canvas for you, so you can look and see, you can check your work. I also posted in a little bit more convenient location the practice problems as well. But let's see. Okay, so first thing we need to do, so let's look at our, we've got to figure out the employee's adjusted wage amount. So step 1A is going to be the $2,650. Paid bi-weekly. I guess I could write this here too. Go. Bi-weekly, so we've got 26 pays. C, amount from step 4A of the employee's W-4, we don't have anything in the 4A, so that's a 0, which means that D is also a 0 because we'd be dividing it by the amount on 1B. Add lines 1A and 1D. All right, so 2650. Also, we don't have anything on step 4B, so that's a 0. And G would be a 0, which means that this ends up being the 2650. Okay, so easy problem for figuring the adjusted wage amount. Now we need to figure the tentative withholding amount. So 2A. We're going to find the row. So based on our pay frequency, we've got to find the correct table that we're going to use here. All right, so she is paid bi-weekly. So we're going to scroll down to the bi-weekly table there. She's married, filing jointly, so it's going to be one of these two. Checkbox is checked, so we're going to use this table here. All right, so remember, we're going to look up the amount in column A for the row that we're using. So 2650 is going to be right here. So the amount in column A, 2375, is what we're going to put here on 2A. Step 2B, the amount from column C of that row. Column C, 20864. Right here. Uh, 2C Enter the percentage, which was 22%. To D, we're going to subtract line 2A from 1H. All right. So 2650 minus 2375 gets us to, what are we at? 2650, 2375, I didn't write it down. I should be able to do that in my head, but I'm not gonna. 275. Step E, multiply the amount on line 2D by the percentage on line 2C. So 275 times 22% gets us to $60.50. F, we're going to add 2B and 2E. So 208.64 plus 60.50, which gets us to 269.14. Okay, we're not done because we've got an amount in line in step 3. So we're going to do step 3 down here. Enter the amount from step 3 of the employee's W-4. Step 3 is 4,500. Divide the amount on line 3A by the number of pay periods. 4,500 divided by 26 pays, 173.08. So 40. For C, subtract line 3B from line 2F. All right, 269.14 minus 173.08. $96.06. We don't have anything for step 4 because there was no additional amount to be withheld. So the amount of withholding, $96.06. Questions about that? Test yourself on the rest of them. Don't look at the answer key until you've done them, so that it doesn't help you at all to just look at the answers when you're just doing it for yourself and for your own understanding. Any questions about that percentage method? Okay, so for problem 6, what you've got is you've got some pre-tax deductions, $500 toward the 401k, $150 toward health insurance, so that's going to reduce taxable income, right? But the employer is paying, so this is a taxable fringe benefit that the employer is paying for, which means the value of that $75 is going to get added to his taxable wages, and it's going to be subject then to that federal income tax withholding. Yep, so that's going to be added, but it looks like there's no dependence or anything, so there wouldn't be anything, there's nothing mentioned about step 3 or step 4, items that would be in step 3 or step 4 there. So it's really just those taxable wages, figuring out those taxable wages for number 6. Okay. Make up some of your own too. You know, I had actually, this was ChatGPT put these together for me. I asked it to put together some example problems. You can do the same thing and quiz yourself. Don't trust its answer. I will tell you that. Do not trust its answer because it is oftentimes wrong with the answer, but it can at least generate some questions for you so you can quiz yourself and give you some practice. And I'm happy if you come up with some and you want to make sure that the answers are right, I'm happy to go through them and make sure that those answers are correct. So really quick, and I'm sorry I have to kind of rush through this. We'll go through this again on Thursday, what I'm going to talk about here. So what we're talking about are supplemental wages. So if somebody receives a bonus or a commission, there are a couple ways that the employer can pay that. They can include it with the taxable wages. So what they would do in that case is they just add it up here to this amount and they'd tax it all together. So if this person got a $350 bonus on this paycheck and it's all being paid at the same time, they're just wrapping it up in this same paycheck, then this amount would end up being $3,000 rather than the $2,650. So that's one way to handle these supplemental wages, bonuses and commissions. The other way to do it is to pay for it separately. So if the employer wanted to give us like a separate check or a separate direct deposit, in that case, they handle the withholding a little bit differently. There's a special bonus rate for withholding, and it's a flat 22%. Or if you're lucky enough to get $1 million bonus, I hope that someday all of you are lucky enough to get, I doubt I will ever get one, but there's still hope for all of you. If it's over $1 million, that tax rate goes up to 37%. So if you got $1 million bonus, they'd be withholding $370,000 in federal income taxes, not to mention the state taxes and all the other stuff that goes along with it. Luckily, that would at least put you over the Social Security threshold, so you wouldn't probably have to worry about that. So those are the two ways that you can do that. You can combine that bonus with the regular pay and use those tax rates. You just add it to the taxable wages and you take all the steps that we just did. Or you can, if it's going to be paid separately, then it would be taxed at those flat rates. There is a way, and I'm not going to go through this now. I'll save this for Thursday. We'll start with this on Thursday. There is a way to gross up the bonus, which means that the employer wants the employee to receive an actual certain amount in their net pay. So for example, this individual got $350 bonus. Maybe the employer wants them to actually get $350 in their pocket. We know that if the employer just pays them $350 in a gross bonus, the employee is not going to get $350. They're going to have Social Security and Medicare taxes withheld. They're going to have to pay federal income taxes, probably state income taxes. There is a calculation that we use for those instances when the employer knows how much they want the net pay to be, and then they gross it up. So we'll start out on Thursday going through that. It's a pretty easy calculation, although sometimes students get tripped up on it, but it's really a pretty easy calculation to do. And that's where we'll start out on Thursday. Okay?